Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 264th VideoCast podcast for the week ending November 7th, 2024. We got a lot of great stuff to cover today. Family first, this is Mimi and Annabelle. Annabelle started 6'8 Water Polo Academy part-time and loves it. She's by far the youngest athlete ever admitted, but because of her speed, they gave her a spot. Mimi flew to Chicago today with her coach and the 908 Water Polo Club to compete in the Champions Cup. This prestigious tournament brings together top middle school players from clubs across the country who each qualified from their respective zones. The winners of each zone face off in the Champions Cup to determine the ultimate champion. 908 is entering the tournament as the number one seed. So very, very proud of them. And let's see what else we got this week. That's Mimi at Portillo's. I know that's been an Ask Me Anything question for some time. And that's one of Mimi's favorite. They have the Chicago-style dogs, which is appropriate because she's in Chicago this week. And that is the studio where Varney & Co. is shot. So you can see behind the scenes, that's the desk we sit on. That's Stu Varney in the background. Very excited. So let's get down to media. First and foremost, I want to thank Stu Varney. I want to thank Preston Mizell, and I want to thank Christian Dagger for having me on Varney & Company Fox Business this week, right after the election. At the top of the hour, 9 a.m., start of the show, we talked about the implications of the election results. So we're going to tune in here.
Left-hand side of your screen, that's Dow. That's stock futures. I mean, they're way up. 1,200 points up for the Dow, over 116 for the S&P. That's a rally and a half. It's a Trump rally, let's be obvious about it. Tom Hayes joins with this morning, checking out the market for us. It's a Trump rally, obviously. How long does it last?
Well, that's a great question. This is what lower regulation and lower taxes look like, Stuart. I wouldn't chase this up immediately, but I think this is a sign of great things to come over the next 4 years, no question about it. The opportunities here, obviously, you're seeing small caps outperform this morning, up 6%. We like regional banks. That's going to continue to flourish. And Intel is, interestingly enough, I know I've brought this up on the show. Remember when it collapsed below 20 and I said, Stu, I think it's a buy here. It's trading below breakup value. It's up 4.5%. Why? Yeah. Because Trump is going to want to manufacture those chips in the United States and reduce our dependency on Taiwan for our chips. That's a national security thing. Mm-hmm. And another one that, again, no one likes is Boeing. Boeing was up 300% during Trump's first term. This is a hated stock right now. They've just resolved the rally. I think there's going to be opportunity there as well.
You're assuming that Trump has something to do with a turnaround for Boeing. I'm not sure
Boeing
about that.
Is a proxy for U.S. manufacturing, and Trump is all about U.S. manufacturing. This is going to be a manufacturing-friendly environment. There are going to be policies that are going to be manufacturing-friendly, and when you unleash American ingenuity in manufacturing, good things happen.
Why is it not a good idea to buy bonds at the moment? Why buy bonds when you've got stocks rallying like this?
Well, no question about it. However, what we're seeing in the bond market is the positioning is so short from hedge funds and from large traders. They're the most short that they've been bonds since October of last year. And following that, there was a rip-your-face-off rally in bonds in November and December of last year. So I think after this initial shock effect, after the market settles out in the next few days, we also have the Fed on Thursday. That's a big decision. Fed will continue to cut. Probably have to cut less than the market is pricing in right now, but they will continue to cut. I think there is an opportunity to selectively buy bonds in the coming days. Not immediately today. This is the shock effect. But with as much as they've come in the last month, there's opportunity there as well.
Look at that yield on the 10-year. 4.46.
Yes.
How about that? It was 3.6
a
few weeks ago. That's something else. Tom, thanks very much indeed.
Thank you, Stu.
President-elect Trump calling.
And we're back. And then I want to thank Chibuke Ogu, who quoted me in his article today for Reuters regarding the Fed cut today. Definitely want to read that one over at hedgefundtips.com. And then want to thank Luca Blauman for including me in her article on Alibaba and the turnaround's just beginning. Quotes of the week before we get down to it. First, from Warren Buffett, the stock market is a device from transferring money from the impatient to the patient. So many people are shaken out of great stocks due to bad headlines because they don't know what they own. They haven't done the financial analysis. They haven't done the research analysis. And on this podcast every week, we do our best to share some ideas with parts of our framework, how you can do that. And for many of you, it's helped quite a bit. And we've been getting such amazing letters and feedback. Very, very grateful for that. My idea of a great business is one that has a shortage of competitors. That's from Peter Lynch. And that's why we keep pounding the table on Boeing. The strike is over. They did do some dilution, but it only takes the share count back to 2014 levels. They bought in a ton of stock. And as soon as the cash flow spigot turns on, they're going to buy in all that stock once again. So hang in there. They've got a 10-year backlog, $500 billion. There's not a whole lot to think about there. Warren Buffett, it's better to hang out with people better than you. Pick out associates whose behavior is better than yours, and you'll drift in that direction. That's from Warren Buffett, and that's been my rule. You know, as I've said many times on this VideoCast, I've never optimized for maximum AUM, and certainly it's been rolling in, and we're very, very grateful for that. But, you know, the reason I do that intro call with everyone that inquires about investing each quarter is because I want to work for people that I am super excited about when I wake up every morning to make money for them. I like them, I respect them, I admire them, and each and every one of them is better than me in their own respective areas of expertise. So I learn from them, and they're just winners across the board. And that's how I've created my mastermind, is attracting amazing clients and friends around me who many have become friends through all of the things that go into the podcast and referrals and getting to know people. So it's just been an unbelievable blessing, and it's right from the master himself, Warren Buffett. Speaking of which, I will be in Dallas on Sunday and Monday. I fly in super early on Sunday. Great clients of mine invited me to the Dallas Cowboys game. So excited to go to their box and enjoy the game. And then Sunday, we are playing the PGA course in Frisco, Texas, which is unbelievable. They're going to have the Ryder Cup there, I believe, in 2042. So we'll be going to that as well. We take a long-term view with everything. So we're excited. And the reason I'm sharing that with you is because I will have a free window of time between like 10 a.m. and 1 p.m. on Sunday, where I can meet with any existing clients near Dallas and or potential clients or podcast fans who are looking to become clients at some point. Happy to do that. And then also on Monday afternoon, I will have a window of time before I fly after we play in the morning and have lunch between, call it 3 and 5:30 p.m. Somewhere in that window is the safe window. You want to meet for coffee or something, that would be great. Just reach out to me at hedgefundtips.com. Click on the contact form. And while you're there, click on terms. This is all opinion, not advice. We do not know your financial situation. We deal with qualified clients and institutions and accredited investors only. And so there's all of that for you. Moving along, on to our charts of the week. Of course, our favorite reporter at our favorite publication. I put quotes in favorite reporter and underline under favorite publication. Favorite publication is Barron's. Favorite reporter with constant negative headlines about China has their newest People's National Congress is expected to okay fiscal stimulus, but will it be enough? Okay, so let's get down to some of these charts. And for those of you who have been around, you remember 3 weeks ago we went through it was something like 100 consecutive negative headlines about China from this particular reporter for 3 years, basically, is what it comes down to. And the interesting thing is they put a new reporter on the beat, and we're going to go through her headlines because she actually had something very positive to say about Alibaba at $100 after it's come up from its lows at 58. And we're grateful to see that change in shift in outlook. And we'll start to see more and more people get on board as it goes from 100 back to 120 to 140 to 160 to 180. At 200, people will really hate it because they've missed it, and they'll hate it all. And then by 300, everyone will love it, and we'll be laying it off. So same plan since day one. Some happen faster than you expect. Some happen slower than you expect. But let's get down to some new charts here. Here's a chart from someone called Chart Life, and it's the biotech XBI, which we've had for some time. And it shows here we bought in the whole 2022, and then it rallied straight up. We thought we were geniuses until it retested those lows again in 2023. And then it rip-roared rally, did a minor base, and now it looks like it's going to break out for good here. So it's up off the lows from the 60s to now 103. And he's got a target line of 130 because of this resistance or whatever the hell it is. I think this is going to work its way higher than that over time. So that story is just beginning, and we've been patient with that while everyone else sold down in the hole here, and then sold down in the hole again here, and then bought up here, sold down in the hole here. What is the stock market? It is a device for transferring money from the impatient to the patient, and that's exactly what's happening with biotech. Matt Sermonaro works for Tom Lee. He put this out. NASDAQ Composite just had 14% of its members make 52-week highs. We tend to see this sort of breadth thrust in maturing bull markets like the one we have now. Good sign for bulls. So you can see these instances, 1, 2, 3, 4, 5, 6, and this is the 7th where you just see continued follow through, which is positive. China equity funds see the outflow for the 3rd straight week, just in time for the China stimulus tomorrow to offset the Trump fear. I think they'll do something reasonably sizable tomorrow, but based on the numbers we've been seeing in their economy, their export numbers, the numbers that came in this week, it was absolutely, it's moving on its own, and the additional insurance stimulus that they're going to put out tomorrow will just add turbo boost to what's already happening. Great financial crisis pushed stock allocations below the traditional 60 to 65% band. They still haven't recovered. So when you think about getting to euphoric points, you could start saying that in the 60, above 65, which we saw in the tech peak in 2000, and then in the banking peak in 65. We are nowhere in that neighborhood, ladies and gentlemen, which tells me, and with all the positive developments from a policy standpoint, that there's a lot more juice to this over the coming years. There will be 10% pullbacks. There are every year. There will be 20% corrections. That happens. Maybe even 30%. But I think from now through early 2030s, and we've talked about the demographics over and over, the path of least resistance is up because the bulk of our population is still in their early 30s. And that spending should not slow. As a matter of fact, it accelerates all the way to their early 30s. So another solid 6-8+ years that we can make unbelievable amounts of money in a short period of time together. And I'm very, very excited about that. Here is the equity sentiment. It improved in October, but it's not at extreme levels just yet. UK government, biggest fiscal loosening since 2009. So they are turning the stimulus jets on. That will help. GXO, where 50% of their revenues are. Top 10 stocks are 37% of the S&P. So we started to see before the election some hiccups among those stocks. I think that more likely than not, we will see a lot of continued breadth, which began this summer and has continued. That's going to enable the Mag 7 to kind of perform more modestly relative to what they've done off the 2022 lows, and allow those that are just getting started to really, really accelerate, and a lot of these turnarounds to become full recoveries and return to profitable growth again, which we hear a lot in the conference calls. Largest U.S. deficit since the Great Depression, World War II. How did they get out of that? They inflated their way out of it. So expect 3 to 4%, or 2.75 to 3.5% for the next 4 or 5 years. That'll be great. It will bring down debt to GDP probably down to about 80-75%. We saw a similar situation from 1948 to 1956. Actually, it dropped to 57 from 120%. So we're on the same playbook. BOJ signals more rate hikes as it sees receded overseas risks. That will be negative for Japanese equities. That will be positive for Chinese equities. All of that Asia money crowded into Japan when China was locked down. Now it will be forced back in as prices go up and more sentiment shifts in the articles and commentary and narrative, etc. And you're seeing the China manufacturing PMI turn positive again. Manufacturing orders ripped higher in China. Bull bear indicator, again, it's bullish, but it's not at an extreme yet, which means there's probably some gas left in the tank. And seasonally, this is the time of year that it happens. Election, our 3 contrarian pushbacks. This is from HeartNet, one of the best in the business. He says if we get a red sweep, it's best played via small cap. That was similar to what I was talking to Stu about. And best played via China tech. Well, we are overweight both of those, and it looks like we are going to actually wind up with the red sweep. So surging excess liquidity will soon buoy oil prices. We tend to agree. We do think there's probably some opportunity in the servicers that benefit from volumes versus the producers that benefit from price. I wouldn't bet against a big price increase in oil, but I also wouldn't bet for it. So I would play it the safe way, which is that a lot more of it's going to be pumped, and you want to play the picks and shovels versus the ones taking it out of the ground. One of the most important charts in energy policy now, in our view, this is from Bank of America, and they talk about energy source and return on invested capital by source. And as you can see, the worst return on invested capital are wind, biomass, and solar. Expect to see less of that in the next 4 years. And the highest return on invested capital are nuclear, hydro, coal, and natural gas. Expect to see more of that in coming years. Nuclear is the cheapest clean energy when all costs considered. And U.S. economic growth extends solid streak. GDP rose at 2.8% annual return in the third quarter. Also speaks to what we said. There would be a lull in earnings this quarter, although they're up over 5% relative to 4.2% expectations, and then a massive reacceleration to double digits in Q4, which seems to be playing out. Chinese manufacturing, again, the official indicator back into expansion above 50. China factory activity expands for the first time since April, official survey shows. That's different from the Caxton survey, which I'm probably slaughtering the name pronunciation, but you know what? I'm an American. I am what I am. India over Chinese equities has collapsed in the last few months. We talked about that. The hot money is going to come out of India and back into China as price goes up and opinion follows trend. A solid 2% beat with surprisingly strong guidance. 2% above estimate. So it was 4.2. They're saying it's 6.2. FactSet saying it's 5.2. Okay, it's better than expected. It's not blowout better than expected. We had been beating by 3%. Now we're beating by 2%. But you can see sector by sector. Mentions of bottom surged in the earnings calls this quarter, which historically indicated an EPS bottoming cycle, which we have been talking about publicly for the last few weeks, that Q3 would be a bottoming and then a re-acceleration. Corporate sentiment indicator fell so far this earnings season, but it's at record highs, so it's nothing to be alarmed about. It's just cooling a little bit like it does in every bull market trend coming off a recovery. Boom to new highs, a little check back like we had here, and then a pullback, and then you keep going. The indicator suggests 12% year-on-year EPS in Q4 versus 9% consensus. And then you can see here the lull of the unmagnificent 493, the deceleration of the magnificent 7 in terms of earnings growth, and then the massive reacceleration over the next few quarters for unmagnificent 493 and the stabilization of the free fall of the Magnificent Seven earnings growth due to all the tech spend. Pause before reacceleration. 8 out of 11 sectors are expected to see decelerating earnings growth in Q3, and then you see the re-acceleration in Q4. So the worst are expected to be industrials, energy, and materials, and then next quarter they all rebound. Materials, for instance, from negative 9% to plus 11. We're playing that through Albemarle, as we've talked about. Then you've got industrials, negative 6 to negative 1. And then you have groups like financials jumping. We're playing that through the KRE, the regional basket, which we bought in that meltdown in 2023. And then what else here? Another utilities are expected to reaccelerate. So they'll have to sell off more for me to get interested. Demand recovery equals higher margins. So we are seeing that. Easing rate pressure should translate into a pickup in manufacturing. We got another cut today as expected. This speaks very highly of the Fed, who have now proven themselves to be an apolitical organization, meaning they followed through with expectations and the plan irrespective of their guesses about future policy and or the results of the election. So kudos to them. As I've said since day one, which was a minority opinion, which is now becoming closer to a consensus opinion, is that our terminal rate would be much higher than the market had anticipated. Market was saying the terminal rate would be around 3. I think they will be done around 4 because growth will be strong enough. And that's what happens in a mid-cycle cut like 1995. You don't need a ton. 125, 150 bips is enough to get the machine going and preserve the jobs. Falling mortgage rates also suggest a pickup in housing. So they peaked yesterday. They're coming back down. Just like when I said with Stu, wait for it to settle out a day or so and then buy bonds. I think it's a good time to buy bonds. And as a matter of fact, we had slugs of new money from existing clients come in, and we were able to get a little exposure there as well. Falling mortgage rate suggests a pickup in housing. That will help Generac, which is doing fantastic. That will help Stanley Black & Decker, which is on track with their plan, just not fast enough for Wall Street. So the impatient sell to us, and the patient stick with it and cash out at a double plus in a year, in 2 years, in 3 years. It doesn't really matter. Worst of the inventory destocking cycle is likely behind us. So you say, well, we missed. You say, well, then I missed it because Tom was talking about that it was going to bottom a year ago, and we've had this huge rally. Yes, we have. But look, historically, there's a lot of time after you get from these depressionary type of destocking cycles to restocking that you get years of upward bull market after that bottom. So we haven't even got over the midline yet. And then even after that, you get more and more and more. So this is the beginning. We are just getting started. This, I got to say, aged extremely well. I put this out on Monday morning, which was the day before the election. And I said, I wonder if all these put buyers ahead of the election are going to get paid, with a funny face, I don't know, whatever, emoji. History does not suggest it. The 2024 put-call ratio, followed by second post of 2016 put-call ratio, and third post of 2020 put-call ratio. Not to worry, whoever's elected will take credit. So you can see here that the put-call ratio got up. It actually got up, spiked that day at 130, which is extreme. There was so much fear. And then same thing in 2016 before Trump got elected. It spiked up to 140. And then same thing in 2016, even with Biden, it spiked up to 120 right before the election. And then what did you see? A collapse in VIX and a rally in S&P. Collapse in VIX, rally in S&P, collapse in VIX, rally in S&P. Why do you get that all at once? Is because you catch the whole market off sides. And there's no way the sellers of that premium are letting these people get paid when everyone crowded in to pay the most expensive price at the exact wrong time for insurance, they got smoked. Okay, so it happens every time, and so this wasn't it's not a crystal ball that I look into. It's just seeing these patterns over and over again and recognizing them and being able to benefit from them. So versus buying puts, you're buying stocks, and then you got the enormous rally the next day. And that's a good thing, not a bad thing. You didn't have to predict the election to know that put premium was too high. Non-farm payrolls month on month, that was a terrible number. Even if you add back the strike and the seasonality and you were at plus 120, if you had 112, it's still, Fed is aware and doing the right thing to alleviate major weakness in the labor market. Given hurricane distortions, okay, we covered that. Supply headwinds are easing for oil. Inventories should be more supportive for oil prices. We covered that. Souring profit views. Analysts have been cutting estimates on Mag 7 earnings growth for next year. Expect more of that. They're spending on investments that are not showing a reasonable return on invested capital yet. And that's why I think the other businesses that have been starting their post-COVID recoveries are now in a position to really take great advantage. So here's the Slumer report from my friends over at RBC. You know who you are. And this is just taking a step back. We've covered this many times over the years, and nothing's changed here. And this actually points to what we actually covered in the beginning, which this is going to continue to run till the early 2030s with, your normal 87 pullbacks and all that stuff happens. 18 years of sideways consolidation like we had from 2020 to 2014, give or take. Same thing in the 70s, same thing in the 30s, and then you get a couple decades of a bull run like you got in the 50s to late 60s, 80s to 2000, and 2015 to 2033, 2034, something like that. Early days, a lot of money to be made, and on that basis, Slumer's talking about 14,000 on the S&P 500. We're at probably 6,000 by the end of the year, so we got a lot of money to make together, ladies and gentlemen. I'm super excited. I am smiling so wide I could eat a banana sideways, maybe 2 bananas sideways. How's that for a late Thursday night? Here we go. A repetitive 3 to 4 year cycle. So he's talking about liquidity stuff and how they bottom. So that's another cycle thing. Uptrend intact, momentum slowing a little bit. All right, that may be early next year. We'll see a little bit of pullback before people have some clarity on the policy. Here's his Fibonacci extensions. We've hit the 161.8. Do we pull back to the 50-day or the 4-year moving average, whatever he's using here, or do we go to the 261 extension? We'll see. That's not where we make our money, but it's good to have these things in the back of our mind. Monthly seasonality since 1928. November is fantastic. December is also fantastic. So this is a good time of the year, not the time you wanted to be buying puts when they were at their most expensive, highest volatility, highest price at the exact wrong time. AAII Bull Bear Survey. Actually, I didn't look at this today. Let's take a look at it and see where it came in. Probably 41. Okay, so it's up there, but not extreme. Bearishness is ticked up a little bit, but okay, got it. European stocks breaking out after a long cup and handle. That's good to see. IFA. What we got here? Yeah, and then you got Europe here also breaking out of a large cup and handle. Hang Seng just getting started, broke the downtrend line, back to retested to take everyone out. Next stop, 26,269 before starting to approach new highs once again. We will get there. The game is just getting started, and maybe tomorrow we'll have some nice impact on that. Into end of year. 10-year yield looks like it. Okay, the peak was 515, so now we got this counter trend to 440. After I was on Stu's yesterday when it was 440 or something like 444, it's dropped 10 bips today. This was a good day to buy bonds, ladies and gentlemen. Again, this is a counter trend. Maybe I'm wrong. Maybe it shoots back up here before rolling over, but I think we're done here, and the trend is going to remain intact for the downtrend. It did. It went up to this line already. This is a couple days old, so that's exciting. Dollar, same story here. This is such a tiny counter trend move. This is what's happening, ladies and gentlemen. The trend is down. Trump wants a weak dollar. He'll get a weak dollar. People are going to get caught off sides chasing this stupid interpretation of what's going to take place. And the opposite is actually true. Canadian dollar, have no fear, loony friends. Relief is on its way. And I would be a buyer of the loony here. I'd be a buyer of all the emerging market currencies, Australian dollar, even the euro. But that's not our game. We don't have to guess and gamble on direction of currencies. We can actually just buy great companies and play the time arbitrage game. Okay, gold, not for me. Emerging markets starting to roll. China happens at the bottoming and early uptrend cycle. So we're excited to see that. What else? Energy will be our natural gas play, emerging markets. Healthcare is biotech, small caps. We're kind of in this group here, mid caps, okay? And tech already happened. So tech is on the downtrend while all this stuff is back on the uptrend. I love these industry group cycles. Biotech starting to move, etc. So that's that. Thanks over to the RBC people. Here's from Koifin. Alibaba has picked up the steam on its share repurchases after accelerating repurchases over the last few quarters. Alibaba has reduced its share count by 10% over the previous 12 months. This is unbelievable, ladies and gentlemen, which means you basically got 10% more of the pizza pie without putting out any more money. 10% more share of their cash flow, their massive $20 to $25 billion a year free cash flow is yours. 10% more of their $80 billion cash flow without taking one extra dollar out of your pocket. 10% more of your ownership of Taobao Tmall, the toll gate for the China recovery. 10 to 20% more of what will be the most exciting growth business in the next 5 years in China, which is the cloud business and the AI business in China, which Alibaba is the biggest, the best, the baddest player in town, and it's going to rock and roll. So excited to see that. Moving on, S&P rally is yet to hit average of past bull markets. Oh, by the way, we didn't finish our charts of the day. Okay. Ryan Dietrich, here's how stocks have done after the past 24 elections. Basically, a year out, you're up on average 7%. So that tells you that the indices are going to not do well. Why? Because those top 10 weights that make up 37% are going to do less well and maybe negative. And then the rest of the market can do extremely well. And the index will still only go up 7%, even though many of those stocks are going to be up 50+%. And that's going to happen. So that's that. Last 3 election cycles, you get rallies after weakness into the election. Jason Gopford, VIX puts was more than 2x that of calls on Friday. Again, things you see at bottoms, not tops. Divided we stand, united we stand taller. This is interesting. This goes against all the data. You know, most of us look at post-World War II data from 1955 and beyond. But if you actually back up to 1928, which is kind of less reliable data because the financial regime was different, but it's still interesting to see. If you go back to 1928, a unified Republican outcome actually had the highest returns of all of the outcomes. If you go back to 1928, if you start at 1955, you want a divided government. But if you go back, close to 100 years, on average, the best outcome by a hair, unified Democrat would be 9%. Unified Republican annualized return on the S&P 500 would be like 9.25. So that looks like it's going to be the outcome, which again points to the positive things we're seeing. Positive economic surprises return to China. The gauge turned positive for the first time since the beginning of the year. We're very happy to see that. Services turned up. Hong Kong PMI exploding off the charts like we haven't seen in years. Hong Kong new PMI new orders up. Cumulative daily performance for November starting in 1950. You can see here some strength in the early part of the month, a little dip in the mid-month around third week, and then a rally into the end of the month. Same thing with the cumulative performance starting in 1990. So it's the same pattern. Up the first handful of days, sideways, little pullback, big rally, end of the month, best month of the year. Large caps trading at a valuation premium to history while small caps at a discount. So large caps over the last 20 years have averaged 15.8 times. They're now at 21.5 times, whereas small caps have averaged 16.3 times. They are now at 15 times. So you can pay a premium and get decelerating earnings growth, or you can pay a discount and get accelerating earnings growth. Same with mid caps, your call. And you'll see we do have a lot of mid caps in the portfolio and one or two critical small caps. Moving along. We saw this year for the first time the top 5 contributed about half, but the bottom 495 actually started to contribute this year, 11.3% of the gains. That's from Ritholtz. Aggregate bond futures positioning in thousands of contracts. So we usually cover the commitments of traders on this report. They've just assembled the data in a different way. And if you remember, we were pounding the hell out of TLT and buying bonds last October. We got a rip your face off rally last time. All the hedge funds and all of the large traders were this short bonds. We are going to get a rally in bonds. Watch what happens. So we were in the market while everyone else was selling in the hole. Popular vote gap between candidate elected and runner-up. Reddit notes where the president lost the popular vote. Okay, that was not the case this time. Our strategists expect mortgage rates to remain elevated, falling to 6.1% by the end of next year. Yeah, that's probably in line with a 4% terminal rate. I think that's kind of the name of the game. I think if you can lock in something with a 5 handle, high 5 handle, you're going to be happy. And that's probably, I don't think you're going to see 4s this cycle. Let's just put it that way. I think if you get something in the 5s, lock it. If you're wrong, you refinance. If you're not, then you're happy you locked it in. And even if you don't need a mortgage, sometimes it makes a lot of sense to have one because you can make the spread. If you can make 10% in with your eyes closed in a passive strategy, and you got 6% money on a couple $1 million loan, you've got an $80,000 a year free cash flow for doing nothing. So that's kind of nice. So if you can lock in low capital, that's what you want to do. Bloomberg, and if you have an active strategy, which is generating much bigger returns, you definitely don't want to tie up that $1 million or $2 million bucks in a dead house that's only going to appreciate, if you're lucky, at 2-3% a year because you've already had the appreciation in the last 3-4 years. Versus in the markets, you can get a lot more and make a massive spread. So use their money if they offer it to you. Bloomberg, U.S. 2025 housing starts consensus forecast. Okay, so yeah, they're all saying they're never going to build a house again. You'll see that'll change. Bonds will rally. This market will be so on fire, like nobody's business. Covered the daily performance for November. Daily performance for November starting in 1950 in election years. So you get a rally early month, and then you get a little chop, and then you get that rally at the end of the year, similar to normal years. A little bit of weakness into the 20th. That seems to be the theme. Strength in the beginning of the month, weakness into the 20th, rip your face off rally to the year end. So you just sit this stuff through. I mean, I wouldn't try to get too cute with it. Rally fades after the inauguration. This is from Macro Bond. So here's the election. We kind of tracked exactly what they were talking about. And then you get a rally through year end. And then after the inauguration, you get some weakness, sideways consolidation for the first 4 or 5 months before a year-end rally in year one. So I think that's a fair thing. Make our money while the sun is shining through year end, and then market will be more subdued, but we'll be in companies that are just taking off, and that will help us when the Mag 7 are doing less well. Our stuff will flourish, and I like that setup. Average PE ratio of the top 10 companies in the S&P 500 is almost 50 while they're accelerating, while their earnings growth is accelerating. So you can buy this stuff because it's worked in the last 10 years. But if you buy it over the last 100 years, you get your face ripped off. So I will take the average of the last 100 years over the last 10 years of data any day of the week. And this was an exception. And people are thinking with recency bias, what has persisted in recent years will persist indefinitely into the future. And I put greater weight on the cycles of 100 years than the aberration of 10. Treasury bond bottomed out here, starting to rise again. Same story that we've covered. Institutional client selling has typically peaked in October. That's because their end of year to book losses for mutual funds, etc., is at the end of that period. And mid and small cap update. So you see it just breaking out of this long consolidation, cup and handle for the technicians there. 10-year yield hitting the top of that range, which we talked about, ready to roll back over. NASDAQ, S&P breaking out, Russell rocking and rolling. That's from Schlumer over at RBC again. Jason Gopfert, indices soared while the average stock did not. This only happened 3 unique times. And positive outcomes 12 months later, average up 14.6. I don't, that is what it is. Small cap breaking out, small cap 600. This is really positive news. Implication is a measured move of 1850, give or take. We're only at 1500 or so. Dow Transport's breaking out. That's a sign for the health of the overall market. That's good to see. Consumer discretionary is now outperforming staples. We were hammering the table on that in September when everyone was buying utilities and staples at the top. China exports through the roof today. That's big improvement. Value factor had its best day since the worst of the pandemic. Basically right after the election yesterday. So that's a sign of good things to come. Emerging market equities at lowest price versus U.S. equities since 1969. For those of you around then, absolute fortunes were made in the 70s and 80s in emerging markets equities coming off that level of low valuation. U.S. IPO volume higher under Trump before pandemic years. So when Trump was in office, you had massive amounts of IPOs. In the last 4 years, you've had a collapsing of IPOs after the COVID spike. So expect that to reaccelerate. Expect animal spirits to be on the prowl in 2025. GS IPO barometer points to improving backdrop for IPO activity. That's like asking the barber if you need a haircut when Goldman Sachs says IPO activity is going up. But they're probably actually right. And sometimes when the barber tells you you need a haircut, he's right too. S&P typically rallies after presidential elections. Okay, we know that. S&P, okay, here's the data. November is historically the best month of the year. That's from Carson over at Ryan Dietrich over at Carson Group again. So we're seeing that November, December, January are historically the best 3 months of the year. So that's why, again, fully invested and moving forward. On to the next. S&P rally is yet to hit average of past bull markets. So the benchmark has gained 152% over 50 months on average for a bull market. So far, we've only gained 65% through 25 months. So about less than half of the returns for less than half of the times of the average. It can go much longer than that as well. So that is a positive thing quoted here in Bloomberg. China's economy shows flashes of stimulus taking hold. That's what they've done before, not even what they're going to do moving forward. We've talked about some of those data points. China home sales see first monthly rise in 2024 on stimulus. Value of new home sales from biggest developers rose by 7.1%. Sales rebound was lopsided with state firms luring buyers. Buy Alibaba stock has soared. It's still cheap enough to buy. This is from a different writer at Barron's named Teresa Rivas, who wrote a very nice article here saying that it's just beginning, and we agree. Boeing strike ends, workers set to resume. We covered that earlier. Finally, that got done. Fox Corp shares soar as record ad boom ahead of elections helps revenue beat expectations. And I will say, probably the incredibly fantastic content over at Fox Business is not hurting them either. I think they do an unbelievable job over there. And the main station, they're getting a lot of eyeballs for sure. Advanced Auto Parts closes the sale of Westpac to Carlyle, which basically takes solvency risk off the table. They got $1.5 billion. The CEO is doing everything he said he was going to do. It's just the market's a little bit impatient, and that's the design of the market, is to simply transfer money from the impatient to the patient. So let everyone sell in the hole in the 30s, and they'll buy back from us over 100. Moving on. Chinese Single-Day Shopping Festival is more than halfway over. Here's how consumers are spending. They're spending on all the things that Alibaba sells. Alibaba brings Singles Day to the U.S. with AliExpress offering alternative to Black Friday. Love it. China reviews debt swap plan as top legislator meeting begins. So it's refinancing the local hidden debts. Expert is bullish on China's Alibaba. That's Barron's Roundtable on Fox Business, a great show every week. Berkshire sold 25% of its Apple stock in the third quarter, so Buffett knows what's up. Moving along, Intel CEO turnaround mirrors some moves by Steve Jobs. So he's getting focused on simplicity and everything else. They had a great reporting quarter, better than expected. Gelsinger was in the market buying stock again yesterday, $250,000 of stock in the market from his own checkbook. Jeff, who works with us, picked up on that. Good work. And that's that. Intel posts more than $16 billion loss, but kitchen sink quarter, but says outlook is improving. That's why the stock's up. There's also rumors that Qualcomm wants to buy them. So it was over 26 today. Couldn't give it away at 18. Everyone wants it at 26. Not even beginning, ladies and gentlemen. Just the beginning. Trump, like I said to Stewart, Trump is going to want those chips manufactured in the U.S., and he's not going to want to give money to Taiwan Semiconductor to do it. He's going to want to give money to Intel to make it happen. And my guess is Musk will be supportive of that because Musk needs a ton of chips for his XAI and other things like Tesla. Beijing puts no price cap on land sales, signaling property market shift. China's central bank affirms supportive monetary policy stance at closely watched meeting. Chinese traders rush to open stock accounts amid stimulus push. Biggest set of stock account openings since 2015, and everyone knows from 2016 to 2018 the Chinese market went parabolic. So there you go. On to the next. Xi congratulates Trump on his election as U.S. president. China urges U.S. cooperation as Trump trade threat looms. Trump likely to uphold CHIPS Act despite his campaign rhetoric, policy experts say. Trump probably won't try to roll back the bill beyond making some modifications to its implementation, i.e. taking money from Taiwanese companies and giving it to the U.S. company. China October exports record highest jump in 19 months. Imports decline more than expected. Don't know what article was going to be here. Ant International drives AI in cross-border payments to boost global expansion. Trump 60% tariffs on Chinese goods to cut Chinese economic growth by 2 percentage points. So that's amazing. When you think about 60% tariffs, you think it would destroy their economy. Even if the worst case scenario, and it's not posturing, which it always is, and they can't make a deal, which he always does, 2 percentage points could be made up by stimulus pretty reasonably quickly. and they would still be at plus 3% GDP growth, which is above where we are. So that's great, and that's priced in now. So anything better than that is going to be a boon for a rally. What M&A will look like under a Trump administration? It will be nonstop. Lena Khan is in involuntary retirement. She is gonzo, and it's going to be the Wild West again. Companies will be consolidating like crazy. Regional banks will be the number one target. Expect to see 1,000 less banks and a lot of opportunity, and that KRE is going to be the big beneficiary of that consolidation. How Donald Trump won by being Donald Trump. This was in the Wall Street Journal, and I pointed this out not to be political, but rather as a lot of young people listen. I think that's how you're going to have your greatest success in life. You know, God or whoever you believe in put you here with a unique set of attributes and aspects that are unique to you. And when you're young, there is a tendency to try to be like someone else that you emulate. And certainly you should mimic the characteristics that made them successful, i.e. the work ethic, the habits, the frameworks, the things that made them successful. But you have to create your own style, your own unique edge, your own personality. Otherwise, it will come across as inauthentic and it simply won't work. I mean, ducks are meant to quack. That's all they do. If you had a barking duck, it would be the strangest duck that you'd ever seen. And I think that's what Trump has figured out. He doesn't change who he is. And I think that's a lesson to all of us, is really just being yourself, your incredible self, and doing things with your own style, your own pizzazz, your own way of doing it will bring you far greater rewards than trying to be someone that you're not. So that's our message of the week. How to trade the post-election, post-rate cut melt up. Stocks are set to rally further. Blah, blah, blah. What did I even want to cover with this? I don't know. Buy small caps. How Trump 2.0 could push this roaring 20s stock market into roaring 2030s. That's from Yardeni. That's in line with some of the things that we're saying. His reasons to be bullish: taxes and spending. Going to try to lower the corporate tax rate to 15%, which immediately boosts earnings dramatically. Meanwhile, Musk is going to cut $2 trillion, or at least try to cut $2 trillion of costs. That's why that's going to be very positive. Inflation and energy, deregulation. These are the things we covered on Stu anyway. Here's a statement of what changed at the Fed meeting this week. The statement: labor conditions have generally eased. Prior to that, they said slowed. Inflation has made progress. He didn't say further progress, so he's acknowledging kind of it's flatlining at a low level. In support, decided to lower that in support of the committee, its goals. Okay, so they took out progress on inflation and balance of risk. They just said the goals. And they had no dissents. So that was positive, and they moved ahead, proving that they, in fact, are an apolitical organization, which they had been questioned about historically and now have proven with the follow-through today, which was a big one. And they did so with no dissent. A new day stock market and sentiment results. This is the post-election pre-inauguration pattern that we covered. Followed after the inauguration, a little bit of sideways, and then a year-end rally. So that's kind of our initial framework for next year. Notes ahead of the segment. I planned to cover a lot more, but we ran short on time because the political commentator before me had a lot to say after the election, which makes perfect sense. Small caps, regional banks, Intel, Boeing. Favorite small cap is Cooper Standard, which we're going to talk about. And I said oil servicers. We don't own any. We probably don't even intend to own any. But if you had to play energy, that's the way to do it, in our view. Key will be election results. We covered that. Bond seasonality we covered a few weeks ago. Worst in October, best in November. Alibaba, a friendly reminder to all the nervous Nellies out there regarding Trump's tariffs on China. We've seen this movie before. We covered this chart a few weeks ago. Trump takes office in January 2017 and puts tariffs on China. What happens to Alibaba? It goes up 350%. excuse me, it's 4x 300% over the next 4 years while he's in office. That's pretty amazing. Cooper Standard, and China will announce their proactive stimulus on Friday. When the administration changed, Alibaba collapsed. Obviously, there were other exogenous events, but it goes to show you, for everyone afraid of tariffs and sold down in anticipation of tariffs, they're going to miss it. Cooper Standard, click here for the most recent update on Cooper. Okay, so you can go back to all of our original theses when we initiated the position at $5.42 in May of 2022. And yet this thing is still just getting started, even at $16, up 3x 200%. Cooper Standard reports third quarter results. So bottom line here, and we could spend a huge amount of time on this, I think we're not going to. And I think the reason we're not going to go to do that is that I'm going to give you the key theme here. And the key theme is the execution of this management has been nothing short of spectacular in an unbelievably difficult environment, and difficult environment that's going to change very quickly. It's going to change for a few reasons. Number one, the Fed is cutting rates. They're going to continue to cut rates. That's going to lower car loans faster than it's going to lower mortgage loans, because mortgages are priced off the 10-year. Car loans are the overnight plus whatever. That's number one. Number two, Trump made a campaign promise, and if he actually gets a red sweep, he could deliver on, to make interest payments on car payments, tax deductible. So people are going to buy a ton of cars because the average car on the road is 13 and a half years. Plus, that will be volumes probably like we've never seen since 2017, when Cooper Standard was a $146 stock. And now that they've taken out so many of the costs, they could probably out-earn 2017. They earned $7.20 per share that year. They could probably out-earn it by 50+% on the same volumes now. So it's just a question of what multiple is going to be on the stock, 10 or 20 times at the peak. And that is exciting. But the key thing I want to point out, they generated $16.9 million of free cash flow last quarter. That's unbelievable given that the volumes came in worse than expected. They were expecting 15.8 million cars industry-wide in North America at the beginning of the year. They're now expecting 15.5. And on that collapse of 300,000, which was unexpected, they were still able to hold up their adjusted EBITDA guidance of 180 to 190, basically midpoint being the same, with a dramatic drop in cars. And remember, once they get over 15.8, that's kind of their break even. Everything goes to the bottom line. So on every 300,000 cars, 300,000 cars, we're gonna see $3 of earnings per share, which is going to be staggering. It won't be perfect after you get over the first few 100,000 cars, but that implies that by the time they get to 16.5, they could be earning $7 at least. And God forbid they get to a 2017 peak in industry volumes of over 17, the thing could be earning $14 a share. I mean, it is amazing the operating leverage embedded in this. So I'm super excited. But what I'm more excited about is the fact that in 2023, they had 15.6 million cars, and they generated 167 million of EBITDA. We're going to have less industry volume in 2024, and they're going to dramatically improve EBITDA growth from 167 to midpoint, call it 187. So they're going to have 20 million more of EBITDA this year on less car volume. When this car volume goes up to 15.8, 16.1, 16.4, 16.7, 17, this is going to be a money-making machine. It's going to be like a fire hose of cash flooding out and knocking people over. I couldn't tell you how excited I am about this. And this goes to, the other thing is that inventories are building, so we're going to see more and more incentives. We're going to see lower rates. We're going to see more volume, and maybe we'll get the tax deductibility of interest payments on cars from Trump. It's setting up to be something super exciting. So it is what it is, and I couldn't be happier. So kudos to management for weathering a really difficult environment. I love how they've handled it, and I would strongly encourage you to read every single green highlighted thing that I put in this article and took 4 or 5 hours yesterday to go through for you, that we're just not going to go through word by word. Let me see if I can catch. Despite the current headwinds, we believe that both of our product segments remain on track to achieve double-digit return on invested capital as we exit 2025. And if you go back to our initial theses 2 years ago, two and a half years ago, the number one thing that we said we got involved is because management understood return on invested capital, and their plan was to get back to double digits. And they're doing everything they said they're going to do, despite volumes coming back more slowly than anticipated. They've just stopped making excuses and started delivering in any way they can. And wait till these volumes tick up just a hair. What's going to happen to the bottom? Anyway, it's super exciting. Double-digit margin, we're going to be there as we exit in 2025. Certainly, we agree. I mean, this is just super exciting stuff. What else did I want to see here? Contribution. I mean, they're making more with less vehicles because their technology has improved that if the OEM pays them more money for their part, they still have an overall lower cost per vehicle for the OEM, even though Cooper Standard gets more of that cost per vehicle because of their innovation has been so great. So it's an offer they can't refuse. As you know, I grew up in New Jersey. That had a different meeting, but Cooper Standard keeps doing it, and we're going to see the volumes. They're paying full cash interest. They're not doing any PIK. That just shows their level of confidence. They'll refinance early in the year now that rates are coming down. Restructuring standards, volumes. Oh, and basically, the analysts were asking the same question that I asked, which was, okay, it's incredible. You got all these costs out of this business. It's a miracle you're generating positive free cash flow with such low volumes. But when the volumes go up, is that all going to go to the bottom line? And is this going to be a cash machine, or are the costs just going to go up with it? And what he's implying here is the costs are what the costs are. We can basically deliver as much as we want, which effectively means that every marginal unit above 15.8 goes straight to the bottom line. So do the math. Car cost, the benefit per car, depending on the mix, $150 to $200 per car, 300,000 cars. So it just starts to mint. Fear and greed is not near an extreme yet, which is why this thing can keep pushing higher, grinding higher, and burning through all that put premium. Here's Gelsinger's insider buy. Utilities earnings top 30 weights were revised up in the last 60 days. REITs revised down 59 bips in the last 60 days. De minimis. Economic data, I think we covered most of this. And earnings up 5.1%. Estimates came down to 175, so keeping an eye on that. And now on to the Ask Me Anything question. So if you don't like the Ask Me Anything, thank you for tuning in. We'll be back next week, same time, same place. If you do love the Ask Me Anything, which so many of you do, stick around. We're just getting started. So let's go through these. And our first one comes from Nate Kelsey. Tom, you've been looking for restaurants. Take a gander at RRGB. They've been working on a turnaround. Also, appreciate your thoughts on LEG. Thank you, as always. I look forward to the podcast every week. Okay, try to keep it to one each week, ladies and gentlemen, just to be fair, because we do have limited time and a lot of people have been getting in questions, but I will handle these for you, Nate. So what is this? Red Robin. We've covered Red Robin. This is not for me. First off, I don't even like their product, but secondly, no, there's no sign of a cash flow turnaround. This is not for me. Same answer I gave a few weeks ago. LEG, Leggett & Platt. This one is more interesting. It's furniture. They had a lot of pull forward during COVID. It's going to take a while to turn the corner, but I do kind of like this one. The cash flow is still going down. Revenues are going down. Margins are going down. But on balance, I think they can weather it until the cycle turn. And it's a highly cyclical business. But I think their balance sheet is okay. Liabilities. Yeah, it's not perfect, but they should be fine. Yeah, that one's a pretty good one. So I wouldn't, pretty good meaning it's worthwhile to start to do a few weeks of work to determine if you're going to make a meaningful investment in it. So good job on that, Nate. Okay, on to the next. Marianne. Hi, new listener this year and love the podcast. That's Marianne Knapp. Thank you, Marianne. Thank you for what you do for retail investors like me. I'm interested to hear your thoughts on Square and Block, Marianne. Well, Marianne, I'm super happy to do it for retail investors. And to keep this in perspective, there are a lot of very wealthy business people that listen to this every week, a lot of very large family offices and institutions that listen to this every week. And I love the retail investors who stick with this and lose the get-rich-quick mindset and find a way to build durable wealth over time if they apply a more principled framework that is repeatable over time. It can help them go a long way. All right, Block. Look, we own PayPal. We think it's a much better quality business run by a better operator. Block, to me, is probably going to work as well, but it's a lower quality business with less attractive management, and but on the mend as well. So they probably have a better crypto play in Block, but that's not our bailiwick either in terms of expertise. So for me, it's a pass, but I think it'll probably work. I just think they've never historically had a decent return on capital. Block, PayPal has always consistently had a solid return on capital. It's a higher end business in PayPal over Block. So for me, I think Square is much more of a commodity than PayPal is. PayPal has brand value, data value, all the other things that we've covered in recent weeks. So that's where I would play, but Square might work for a trade, but it's just not for us. But thank you so much for the great question, and you'll be able to discern better and better over time as you listen over the years. Hello there. No, that's not that. Drew. Joining the number of stocks at good valuations. Grateful for your thoughts on FMC. That's current valuation, not correlated with China. I like it. I've looked at it. I think it's fine. It's an ag play. We've covered it, I think, in some of the podcasts, and I also said I liked it. So, yeah, I have no problem with that one. But do material work before you invest any material money. Drew, okay. Regan, no. Okay. Calvin, no. And I get a lot of emails. Nick G. Long-time listener, followed your China play. Very grateful for it. Please shed some light on Druckenmiller's bond short position. Oh, look, inflation, really value opinion perspective. Look, Druckenmiller is an absolute legend. I would never bet against Druckenmiller. I will say that I'll just say that I disagree with the view, and we'll see how it plays out over the next 24 months. Moving along, Matt sent me a very nice note. Matt, I replied for that. I don't know if you got my reply, but I really appreciate that amazing note. Very, very grateful for that. Tom, could you please look at WNS Holdings? This is from Rajesh Subramaniam. Okay, I feel like we looked at this, but let's take another look at it. WNS. Business process management, provides data, voice, and analytical transformation. Manufacturing, shipping, and logistics. Okay, so this is a complicated business. It's based in India. Looks like they're into 100 different things. Look, the financials look perfect on this. India is a slight red flag for me. There were a lot of frauds with some of the outsourcing companies over the years. This looks like amazing, perfect numbers. So on a numbers basis, I love everything about it, but I really have to dig in and understand every aspect of their business and what's the competitive moat and get real confidence in the numbers. But this might be a cheaper way to play an overvalued market in China. So I think that's a good find. I think you have to do a lot of work, really dig into management's backgrounds and whether they had success in creating value for shareholders or if they were just promoters. If you can get comfortable in the integrity of management, you probably have a decent business. Then you got to get comfort in the durability of their moat and what's going to keep competitors at bay. And if you can get confidence in those couple of things, which is reflected in their numbers, I think you might have something good here. So that was a nice find, Rajesh. And let's see, Stephen Kim, longtime listener and fan of the podcast. Great to see the Intel investment working out as you've laid out throughout the year. What are your thoughts on ASML? Yeah, it's had a small correction. Look, ASML is a great business with very little competition. I don't think it's coming enough. I'd take a hard look at it at 500, 400, but I don't know if it'll ever get there. So it's just not cheap enough for me to make a double over 2 or 3 years. So for that reason, just a pass for now. But I'll keep an eye on that one and nice find. Steve Frampton, who does the incredible videos you see every day, sent in last week Estee Lauder. And we did respond to that one. We like that one at these levels. It can go lower before it goes higher, but this is a durable brand for 100 years that has a lot of competition, but it's basically hurting because of China, and China's coming back. So this is basically, it's like buying another Baba basically, and Baba's ready to roll. So I like Estee Lauder. They just put the new CEO. People aren't happy because it was an insider, but it's a guy who knows the business backwards and forwards, and he knows how to run the business when China recovers, which it's starting to now, and maybe accelerated by what happens over the next week. And it's a brand that's, they've got Mac, they've got so much other stuff. So if you believe in China, you want to be in this. If you don't believe in China, you don't want to be in it. The risk at these levels, which I'm willing to certainly take, is that the new CEO comes in and does a massive kitchen sink quarter in his first quarter to clear the deck. So he takes a huge loss before doing it. But I think people are kind of expecting that. So it might already be priced into the stock. But certainly it could go a little bit lower before it starts to recover. And this is in early days of recovery. But with this kind of quality of a franchise, if China turns, this thing's going to rip fast. So I think you got a good one here, Stephen. And thanks for sending it in. And thanks for all the amazing work you do on the videos as well. So with that said, we'll be back next week, same time, same place. Hope to meet a couple of you in Dallas. In the meantime, make it a great one. Bye for now.